So welcome to our today's financial management class, and I'm taking this opportunity to get us started with this great chapter. So I'll be looking at chapter number 1, which talks over the overview of financial management. Overview of financial management. Ladies and gentlemen, this subject called finance or financial management, which in those good old days they used to call business finance, basically looks at how a company will get out of its way to look for funds which are needed to finance its operations. So we are reading here, we are told financial management refers to operational activities used in obtaining and effectively utilizing financial resources in the most efficient and effective manner. It involves the whole process of raising funds from the most effective sources, investing such funds in most profitable projects, distribution of the profits or returns to providers of finance, ladies and gentlemen, in the name of dividends. Dividends, that is one of the roles of this subject called FM, or roles of a finance manager will be, one of his roles will be to decide on the amount of dividends which will be distributed from the year's profit after tax. Ladies and gentlemen, also financial management is about liquidity management, what we call the working capital management. If we do not organize and optimally work with our working capital, at the end of the day, we'll run out of our short-term liquidity, meaning that we will not be in a position of being able to pay our creditors when their obligation falls due, And of course, at the end of the day, you'll be learning that a great company is that company that will be having a positive working capital, where working capital is current assets minus current liabilities, meaning that all through the current liabilities here should be lower than the current assets. Ladies and gentlemen, from there, I will take you to the nature and the scope of this great subject of ours called financial management. The most important thing is for you to know, ladies and gentlemen, that we have got what we call private finance and public finance. To differentiate between the two types of finance, you need to know that public finance basically will be used by government institutions to raise capital. What the government institutions like the Treasury, like if Kenya National Hospital wanted to raise money, how do they raise their funds to finance their operations? If that is done, whatever scheme or schemes they'll be using to raise that fund is what we call the public finance. Public finance. And of course, now private finance is the opposite of public finance. Under private finance, now we are looking at these privately owned institutions. How do they raise their funds? How do they raise their funds? Now, when we talk of scope of financial management, we are basically again looking at the functions of this financial management, where we can see that a good finance manager should be able to estimate the financial requirements over the institution, like how much do we need this year. So he should be able to come up with this great tabulation. At the end of the day, he should be able to advise the company as regards to how much is needed for purposes of knowing how this will be raised. So estimating financial requirements, that is very important. Deciding the capital structure. As we shall be seeing, ladies and gentlemen, later on, our capital structure will be having 3 components. We'll be having what we call equity. We'll be having debt. We'll be having preference share capital. So a good finance manager should be able to tell us between the 3 vehicles of raising funds, which one is the cheapest. We start first of all by exhausting funds from this cheapest source first, etc. So we are saying that a good finance manager, as per number 3, should be able to select a sources of finances. And of course, he should be able to decide on the capital structure from the word go. Optimal capital structure. Tell us, for example, the debt should be 50%, equity should be 30%, preference shares 20%, like that. So selection of a particular source of finance, which will be applicable. Decision on the capital structure, all those are functions of the finance manager, or functions of our subject called financial management. Ladies and gentlemen, from there we have selection of what here optimal investments. Once we get this money, we have to decide between the various competing projects that we have, which project are we going to invest in. Of course, we would always want to invest in projects which have the highest net present value, because our main objective is to maximize the shareholders' wealth. So a very important function of any finance manager is to select optimal investments, of course, through appraisal. We have to appraise them. We must look for the NPVs. It is, ladies and gentlemen, the fifth one is proper cash management. We said up there that it will be wrong of you if you are our finance manager and then we run out of liquidity, we run out of our short-term funds so that we are not able to pay our short-term creditors when their obligations fall due, then that will be very wrong. And then we have implementing financial controls. Of course, ladies and gentlemen, the finance manager being among the key managers that we have in the organization, he has to be involved in designing of financial controls so at the end of the day, we don't have leakages in the institution. We should never have leakages in the institution. Note number 7, ladies and gentlemen, is financial planning and the forecasting. Yes, we expect a good finance manager to be on top of the game in terms of budgeting. He should be able to budget and tell us in advance, even the next 10 years, what do we need to be doing? How much do we need to be able to finance those activities, etc. Then we have the concept of risk management. Assuming we are a company that is dealing with foreign exchange. So if you're dealing with foreign exchange, ladies and gentlemen, at the end of the day, during the exchange of this foreign currency to our own home currency, there are chances that you could make losses or profits. So we would not want this variability. We would not want these variations, because at times, if for example, you have this money, when the dollar is going for 105, you have dollars here, when the dollar is going for 105, and maybe you have got $1 million, you'll end up getting 105 million Kenya shillings. What if in this case here, the dollar rate fluctuates and then we have each dollar going for 100? So 100, that will give you 100 million as opposed to 105 million. You can see you're making a loss of 5 million. And that is why a great finance manager should be able to come up with schemes, strategies to ensure that such kind of risks, foreign exchange risks, are taken care of. The downside, the upside, we don't care because we want even to increase our amounts in the upside, in the profitability zone. We want to grow our profits. But the downside, the losses, that has to be taken care of. So that is one of the roles of a finance manager. Ladies and gentlemen, we have the dividend decision. So the dividend decision, ladies and gentlemen, of course, after we have been able to get profits, say we make a profit of 10 million Kenya shillings, it will be wrong of us to sit down as the board and say that you're going to pay the shareholders all these profits that we generated. No. The finance manager has to do his arithmetics and get to know, for example, in the coming period, how much of these profits would we want to retain. So perhaps he could come up with a policy of paying 60% to the shareholders. And they should be able to justify that policy in the AGM. So dividend decision is a key function of any finance manager. Ladies and gentlemen, from there, if you allow Mwalimu here, if you allow me, I'll take you to the goals, roles, or objectives of a firm. These objectives are broadly divided into two. We have the financial objectives, and then we have the non-financial objectives. The financial objectives here, there are two. We have what we call the profit maximization goal and the wealth maximization goal. For financial management, will always, ladies and gentlemen, drum support for wealth maximization. The highest goal for us here will be wealth maximization, However, it will be very important for us to know profit maximization. Remember how we get our profits, revenues minus cost. But remember, ladies and gentlemen, at the end of the day, for us to maximize our profit of our organization, we only get to maximize profit of our firm at the point where marginal revenue equals marginal cost, Why don't we like this profit maximization goal? Ladies and gentlemen, as you're saying here, this is a selfish goal, because an organization has got many stakeholders. It has got many stakeholders like creditors, stakeholders like customers, etc. But these profits you're maximizing belongs to only one stakeholder called the shareholder. So you can see it's not the very best. It only looks at one part, so it's very selfish. Now, ladies and gentlemen, this profit number 2 also, it's vaguely defined. It's vague. We can't understand it very well. So when you tell us to maximize profit, which profit do you want us to maximize? Is it profit before interest and tax? Is it profit before depreciation and tax? Is it profit before tax? Is it profit after tax? Ladies and gentlemen, that vagueness is a big problem. The third disadvantage of this profit maximization goal, it's short term. Every manager will be thinking of how do we maximize our year's profit this year alone. Nobody will be thinking beyond 1 year. Everybody will be thinking just this year. And for this kind of a short-term goal, what will imply here is that most managers will sacrifice all activities that may not be able to bear fruits immediately. All activities which will be benefiting us down the line, even 10 years down the line, will be sacrificed. Activities like training, because I know if I train my workers today, I will not be able to realize the training benefit immediately. So because I would want to maximize my current year's profit, what I would do is to remove the training cost from our income statement. I remove the training cost from our income statement. So this is a model that encourages short-termism, which is the opposite of what here, wealth maximization. Ladies and gentlemen, number 4, you can see there is a big disadvantage there. We are making use of our accounting profits and not cash flows to decide, to make decisions. What do you know about accounting profits? They are easily manipulated. You can manipulate them. You can decide to change policies in between the years. You will decide to go for a policy that will favor you, right? Meaning that these accounting profits, how they are ascertained, is very subjective. It depends on which policy. If I realize that, for example, by making use of straight line method of depreciation, I'm going to have a higher depreciation amount, which will eat onto my profits, ladies and gentlemen. What I will do is to shift from straight line to reducing balance. So these are things that I can easily play around with, unlike what here, unlike cash flows. Number 5, the 5th disadvantage, which makes us really hate profits with a passion in finance, ladies and gentlemen, is that profit model ignores the time value of money. It ignores the time value of money. When we talk of wealth maximization is our major goal in terms of finance. Under wealth maximization, ladies and gentlemen, we shall be using cash flows, which are quite objectively ascertained. Yes. And of course, those cash flows will be discounted. So meaning that here, we shall be taking care of the time value of money. So if it's wealth maximization goal, at the end of the day, we shall be working with what we call the net present value. Which basically will be that present value that we shall get after we discount all the future cash flows, as we shall be seeing later on, and then we deduct the initial outlay. So don't get scared at this particular point. No. Now, ladies and gentlemen, if you allow me, I'll take you through. These are things you'll be able to get in these notes, and you go through the favorable arguments of wealth maximization. I've even given you most of them, and favorable arguments. And then we have these differences. You really need to go through them. Right? It's very important that you get to go through them from your handout. Now, from there, we have the non-financial objectives. These non-financial objectives are quite important, right? You may think that you are making losses at the moment for pursuing them, but at the end of the day, you'll be better off. You'll be better off as an organization. And you're told that such objectives include what? Note one, welfare of who? Employees. Welfare of employees. Welfare of employees. We are told it tries to cater for the needs of employees. Example is through training and motivation so as to ensure that they have the best person required moving forward. Ensuring that, ladies and gentlemen, we retain these people. Whenever you have employees feeling that really this employer of ours is getting out of his way to train us, they'll have some kind of, some sense of job security. That is quite important. So we have fair dealings with customers. Ladies and gentlemen, let's be engaging in ethical means to win customers, These are non-financial objectives, because at the end of the day, even engaging in ethical means to get customers, you could be losing out. But we are saying that for purposes of harmony in the community, we need to live well with our competitors at our role. We need them. For purposes of what here? For purposes of improving our quality, ensuring that our customers get the very best from us. We need somebody who will be poking onto what we do, Then we have responsibility towards the government. As much as you would want, ladies and gentlemen, to be very greedy, ensure that you pay taxes. If you don't pay taxes, at the end of the day, the taxman will catch up with you, and you know, of course, how big, how heavy the penalties and fines are. So that is a non-financial objective. Because if I just pursue the financial objective alone, I'll be thinking of how do I save for the company? How do I save for the company throughout? And then we have responsibility towards creditors, stroke suppliers. Ladies and gentlemen, of course, remember the rule of finance. When we're looking at the financial objective, for us to be able to have a healthy working capital, we are told to delay payments to our suppliers as much as possible. Delay them. So suppliers, in this case, you don't pay them very, very quickly. That's financial objective. But for us here, ladies and gentlemen, we will endeavor to pay these people on time. Remember, even them, their businesses to support, etc. And then the other non-financial objective, which may look very small but very important, is what we call the corporate social responsibility. The responsibility that you have to the society. Remember, as an organization, there is no way you can exist without the society. This society is the one that is buying your products. So if it reaches a level where you realize that you've been making quite some significant profits, let it reach a level where you start again redistributing those profits, in this case here, to the members of the society, for example, who are most vulnerable, or engaging in things like planting of trees to check global warming in future, because we would want good weather, would want good climate in the future for us to continue drawing raw materials from our environment. So it's very important. So those are the none. Now, objectives of financial management, ladies and gentlemen, these are pretty similar to those functions that we discussed there. So to ensure, for example, regular and adequate supply of funds, to ensure that these people get proper dividends, optimum utilization of funds, safety of our investments like that, capital structure. This is something that you should be able to get in this handout. Ladies and gentlemen, from there we have our agency theory. Agency theory, when we talk of agency theory, the most important thing that you're supposed to know, under agency theory, we are told it is the theory that explains the relationship between different stakeholders, related parties in an organization. Remember, in this organization, for it to stand the way it is standing, there are many stakeholders. There are many stakeholders. There are many stakeholders. Now, listen and listen to me very well. When we talk of a principal-agent relationship, we are saying here it is a contract in which one party, known as the principal, one party, known as the principal, delegates his or her duties to another party, known as the agent, who executes those duties, who executes them on behalf of who? The principal. So we have the principal, the major person here is the principal. For example, we look at the landlord-agent relationship. So the landlord ideally should be the one going to collect rent from the tenants. But because of one reason or the other, the landlord may not be very comfortable to go to the tenants direct. So what he will do is to appoint an intermediary in the name of an agent. So the agent now will go to the tenants on behalf of the landlord to ensure that he does what the landlord has instructed him or her to do, collect rent on his behalf. Yes. Now, a good example of an agency relationship that I would want you to appreciate is this, and I will use an example. If, for example, 1,000 people come together, right, contribute each like $1 million shillings, that gives us a billion, 1 billion Kenya shillings. And then they decide to put that into a venture. They open a company, for example, Barclays Bank of Kenya. They open a company, for example, Barclays Bank of what year? Kenya. These are 1,000 shareholders. They'll be called shareholders because they have invested. There are 1,000 shareholders. There is no way these people, ladies and gentlemen, will be able to manage this company in Nairobi here themselves. It will be chaotic because of that number. And even if they wanted, perhaps, even if they had many branches and they wanted to fix themselves in those branches, perhaps they may not be having the technical skills, the technical know-how of running a bank. So then what they need to do is to appoint directors. They could appoint directors here from amongst themselves, or, ladies and gentlemen, they could even get directors from outside there, and then they give them a job. So meaning that ideally, these 1,000 shareholders are the ones who would have been doing the daily management, the day-to-day management of their bank. But because they have decided to go home for purpose of sanity in the organization, they have like 10 directors. Those 10 directors will be executing duties on behalf of the principal, on behalf of the shareholders. So we have here agency relationship between shareholders and management or directors. Now, what you need to know, ladies and gentlemen, is that when these directors are left on their own in Nairobi here to run, for example, Barclays Bank of Kenya, at the end of the day, there will arise a problem. Why? Because naturally, human beings are what here? Lazy and greedy. All of us, we would want good things, but we don't want to work for them. We are lazy and greedy. So what will happen? Those 10 directors may decide to pay themselves huge perquisites, huge salaries. And if they can, most of them will start engaging in fraudulent activities to ensure that the billion is blown to the wind. And of course, it goes straight away to their personal accounts. Corruption, basically. So it is such things that are going to breed, right, what we call the conflicts between agent and the principal. And we are saying in this case here that those conflicts here may include the management may live prestigious lifestyle, fully financed by the firm. They may misuse the corporate resources for their personal gain. You get somebody who has a company's vehicle, but he decides to use this company's vehicle to ferry, for example, his construction, personal construction, for example, sand, do his private businesses. It is these guys here may decide to increase their salaries inappropriately, right? Different. So there are many things that may bring that may bring conflicts, but not the most important thing, because again, if we mess with these directors, we as shareholders, we shall lose big time. So what we need to know is how do we solve these conflicts and ensure that we realign interests of the shareholders vis-a-vis interest of the directors through what we call goal congruence. So ladies and gentlemen, what we need to do in solving these conflicts, number one, we need to introduce employee share ownership scheme plan, where those directors will know that if we work very hard, at the end of the day, we shall become part and parcel of this organization. We shall become part and parcel of this organization. That's very important, very important, very important. Once they know that, then automatically they'll start seeing themselves as owners of the business. So that is one of the ways of realigning the interests, of solving the conflicts. Number two, exercising contractual renewable employment. Renewable employment contracts. So ladies and gentlemen, once these people know that you're sitting on that chair for 2 years, after the end of the second year, we shall sit down to evaluate your work. And if your performance will be deemed unsatisfactory, then we will not regret releasing you. One of the ways, very good ways, of working with these conflicts there. Then number three, we have introduction of performance-based what here rewards. Tell these managers, ladies and gentlemen, that if you make $1 billion this year, we are going to give you like 10% of that profit. So performance-based reward systems will ensure that these guys, the key thing is to make sure that the directors who are left on the ground will toil through to work towards the objective, the goal of the firm, which is wealth maximization. Ladies and gentlemen, we have another way is to scare these people through threats of firing, that if we get you stealing, home direct. And when you get to one of them stealing, please straight away exercise that right that you have as shareholders. It can be either through the AGM or wherever, just fire them. Then we have, ladies and gentlemen, the concept of who? The auditor. It will be very important that we incur what we call an agency cost to streamline things. Have a third eye looking at these directors in the name of an auditor. Ladies and gentlemen, the moment you have those ones, they are quite important. I'm so sure you have picked up a few things here and there, which now can make you look at the other factors very easily. Now from there, we have an agency relationship between shareholders and who? And the creditors. Between shareholders and creditors. Now creditors, of course, these are providers of what here? Finances. So the one who provides finances to you becomes the stronger party. So the creditor becomes the principal. He's giving you his money. You work with that money on his behalf and ensure that you return his principal amount, which he gave you, plus something return on top, what we call the interest. So creditors or bondholders are providers or lenders of long-term debt capital. They'll usually give debt capital to the firm on the strength of the following factors. Existing asset structures, of course, they will need you to give them what? Security. Expected asset structure of the firm after we give you the money. How will the asset structure look like? Then we have the existing capital structure or gearing level. I mean, if you have got a huge amount of debt, will not be willing to add anything in form of debt to you. So you have the existing capital structure and the expected capital structure. Now, ladies and gentlemen, I would want you to understand here, The most important thing, first of all, is for you to understand that the creditors here are the ones who become who? The principal. And the shareholders will be the agents. Now the roles are reversed. Now, what are some of the conflicts? What are some of the bad things that can happen which will mess this relationship up? Of course, when these creditors give you this money, they would want you to have some covenant deed. In the covenant deed, they may ask you never to borrow in the future without involving them. Of course, when you involve them in the future, when you want to borrow again, they'll say no to such borrowing. They'll tell you don't dispose any asset. But in between here, if you're caught up in between a hard place and a rock, in between a hard place and a rock, what will you? You'll be forced to sell something. So, and if you happen to sell something in between here, then that is a potential, a great source of conflict. So disposal of assets. We have asset investment substitution. So you're told these people that you are to invest in this and this, their money is, and then when you get the money, you start taking this money to other, even if it's within the company, that one will automatically be one of the ways of circumventing the covenant deed. This will bring a conflict between the two parties. Another thing that normally brings a big conflict between these parties is payments of high dividends. These dividends are normally paid to who? The dividends, ladies and gentlemen, are normally paid, to ordinary shareholders. When you pay ordinary shareholders a higher dividends, it means that in the future, you will be having a problem in repaying the debt providers, the creditors. The creditors would want to safeguard their interests first. They would want to safeguard their interest first. They would want you to portray the ability of you being able to pay them their interest in future forever. And one of the things they'll tell you is that never pay more than this percentage as as dividends. And of course, if you do that, then you will be at conflict. So we have underinvestment is also a potential source of conflict, ladies and gentlemen, where we gave you 10 billion and you want to invest 5 billion, ending with you having a lot of idle cash. That idle cash, at the end of the day, it means that we will not be able to return enough dividends and, of course, interest to this. So the moment you underinvest, there is a problem. That is a potential cause of cause of conflicts. Then we have borrowing more debt capital. Of course, I don't have to explain that. Now, ladies and gentlemen, we have solutions to this agency problem. The first one is to do a restrictive bond stroke debt debt covenant, where we will swear that we shall not dispose any assets, no payments of dividends from, for example, retained earnings, maintenance of a given level of liquidity. All this will be put under this particular bond covenant. Very, very important, very important. All those issues that may bring conflicts, we put them down in writing. And I have a contract, ladies and gentlemen, in this case here, actioned by a reputable lawyer. A lawyer who is, of course, registered. Then we have the callability provisions, where you are telling these bondholders that should they feel that the investment is at risk, they have a right to ask for their money just on call. Want our money today? They get their money today, like that. Then we have the aspect of representation. You could have, in this case here, one of the bondholders, ladies and gentlemen, coming to sit in all our board of directors meetings. So that is very, very important. Also for you to be able, ladies and gentlemen, to be able to win the hearts of these people, we have this concept of convertibility. So under convertibility, this means that should the bondholders here see a problem, and perhaps at the moment you are not that liquid to refund their money, that they can change their debt for equity. They can tell you, instead of giving us back our debt money, please give us your shares. Like now what is happening at Kenya Airways. Now, ladies and gentlemen, Please let us look at this other agency relationship between shareholders and who? The government. We are told that shareholders and by extension the company, they must operate within the environment using a charter or license granted by government. The government will expect the company and by extension its shareholders to operate the business in a manner which is beneficial to the entire economy and the society. Remember, shareholders and the government happens to be who? The principal. The principal. Because at the end of the day, we are working in these businesses to ensure that we support the government's agenda, job creation, payment of taxes, etc. We are told the government, in this case, in this agency relationship, is the principal, while the company is the agent. It becomes an agent when it has to collect tax on behalf of the government, especially withholding tax and OTR and the payee. So what are some of the potential conflicts, issues, conflict-bringing issues? Like the company may want to evade taxes. That will bring problems with you and the government. Involvement in illegal business activities, yes. Corruption. Lukewarm response to social responsibility calls by government. That will bring issues. There are companies, whenever the government says, for example, you've got this COVID emergency fund, bring a check. If you don't bring a check, there'll be a conflict between you and the government. Now we have here lack of adequate interest in the safety of employees and everybody who is around the company. Safety of your products. Ladies and gentlemen, this is a potential area of conflict between you and the government. So solution to this agency problem, we are told the government can make the following actions to protect itself and its interests. So we have audit is key. We have investigations of companies under the Companies Act. We have the back duty investigation, cost to recover the tax evaded in the past. We have the VAT refund audit. So the key thing here is that the government has to bring in auditors, perhaps from KRA, or even appoint a private auditor to come and investigate the affairs of a private company so that we can do what here? We can have the government protecting its interest. So solution to the agency problem, these are government incurring, that is A, monitoring costs. B, we have lobbying for directorship, where the government, through the treasuries and gentlemen, will have the government like Safaricom and these big corporates. You have like the PS Treasury becoming a director, right? Right. We have C, to realign interests, offering investment incentives like what you guys study in taxation, the wear and tear allowances, investment, building deductions, IBD, etc. Then we can also have our interests aligned through legislations, etc. Ladies and gentlemen, we have agency relationship between shareholders and who? And auditors. Remember, shareholders will appoint auditors to go and throw their eyes to the directors to see what the directors are doing on the ground. So here the shareholder becomes who? The shareholder becomes the principal, and the auditor becomes who? The agent. The auditor becomes the agent. Now, potential areas of conflicts, of course, when I send you down there as my auditor, I don't expect you to collude with those directors. If you collude, then that will be a potential area of conflict. We have high fees. High audit fee is a potential area of conflict, ladies and gentlemen. Yes, it is. High fees is a potential area of conflict. Why? Because, of course, when we pay you highly, we shall be reducing on our profitability. Issuance of wrong reports. For example, you decide just to issue unqualified reports and we know that things on the ground are not right, then that will be a potential area of conflict, yes. We have D, failure to apply professional care and due diligence in the performance of the audit work. That can really put us into, so solutions to the conflict. So we have rotational contracts. So I will tell these auditors that the maximum number of years you will stay with us are 3. After that, we'll have to get someone else. That is a contract we have. And we can also still retain them, but ensure that the engagement Ensure that the engagement partner rotates. He goes after some time. We bring in new. So we have legal action. This is quite important. If they mess around, we have that right of taking them to court. This one will act as a deterrent. Disciplinary action, we can take them to ISPAC and things here will happen. Of course, once CASNEP gets them to, rather ISPAC gets them to be culpable, they'll suspend the auditor, withdrawal of the practicing certificate, fines, penalties, reprimand them, use of audit committees and audit reviews to look at their work. So ladies and gentlemen, that marks the end of our first lesson of financial management. We hope you have enjoyed. I look forward to having the second session with you in a short while. Thank you.